Okay, so now we are going to discuss some questions. Okay, so problem one, PT Atlantica is considering the following investment alternatives. There are three kinds of investment with each respective IRR or the internal rate of return. PT Atlantica plans that each investment will be financed 40% through debt, and it is known that the risk-free investment level, or the RF, is 8.25%. The systematic risk of the company is 1.4, and the equity risk premium is 12%. The company currently has bonds with semi-annual payment, a par value of 150 million rupiahs, maturities of 5 years, and a coupon rate of 7%. The bonds are sold at a price of 105% of the par value, and the company's marginal tax rate is known to be 35%. With the information above, you are asked to calculate the cost of equity and cost of debt, calculate the WACC of the PT Atlantica, and based on the result in the point B, which investment that is worth to invest in. Okay, so this is the questions, and then we are asked to calculate the cost of equity. So in this question, we are going to use the capital asset pricing model instead of the dividend growth model, because there is no information whatsoever related to the dividend payment. So using the CAPM, we can use this formula: RE equals to RF plus beta multiplied by RM minus RF. Okay, you're given the risk-free investment level is at 8.25%, so you just need to plug in the number 8.25% with the beta of 1.4, so you just need to plug this 1.4 number in this formula. And then you know that the risk premium, remember that the risk premium is already RM minus RF, so you just need to put 12% here, and then you can get the result of the RE, sorry, the RE of 25.05%. What about the cost of debt? Remember that the cost of debt, for the cost of debt, we are going to use the YTM. So you were given the information of the par value, the coupon rate, the time to maturity, and then you were given the price of the bonds, the current price of the bonds. So since there is no information regarding the YTM, you need to calculate the YTM using the interpolation method. First of all, the par value is 150 million rupiah. The coupon rate is 7% annually, but since the coupon payment is semi-annually, you need to divide the coupon rate, this annual coupon rate, into you need to divide this annual coupon rate by 2. So that means the coupon rate is going to be 3.5% semi-annually. Okay, and this is how much the coupon is. Okay, and the time to maturity, since it is still stated in terms of annual basis, you need to change that into the period basis, since this is a 5-year bonds, then the time to maturity or the period itself is 10 period. Okay, and okay, now you know that the price of the bond is currently at premium, right? So recall the chapter of the bond valuation. We know that if the price of the bond is larger than the par value, that basically means that the YTM is lower than the coupon rate. Okay, so when you want to do the interpolation method, the first one, R1, you're going to use the same coupon, the same number of coupon rate to the YTM, so you get 150 million rupiahs. And for this one, you need to use lower than 3.5%. Okay, since it is sold at premium. Okay, and if we use the 1%, um, the price of the bond is going to be 185 million five hundred thousand 500,000 517,392. Okay, um how do you get this? Remember that the bond price, okay, the bond price or the bond valuation consists of two things. The first one is the present value of the coupon, and then the second one is the present value of the par value itself. So you need to calculate the present value of the coupon first. Okay, so this is the coupon, and then you calculate the PV/IVA or present value interest factor annuity, and then you add the present value of the par value, which can be found by dividing the par value with 1 plus r, which in this case is 1%, to the power of 10. Okay, so using the interpolation method here, you find that the YTM is 2.97% semi-annually. Remember that the YTM needs to be stated in the annual basis. So this YTM needs to be multiplied by 2. Okay, and you get that the YTM, the annual YTM is 5.94%. Now you have found the cost of that. Okay, and then you are asked to calculate the weighted average cost of capital from PT Atlantica. From the question here, you know that the company is going to finance the investment using 40% of that. So that basically means that the weight of the debt is 40%, while the weight of the equity is 60%. Okay, and since we are given the information regarding the tax rate, okay, we need to also calculate the cost of debt, the after tax. Okay, for the cost of that, we need to multiply weight of that with the YTM, and then we also multiply it with 1 minus the corporate tax rate, which in this case is 35%, and then we add the weight of equity multiplied by the cost of equity that we have calculated here, 35.05%. Okay, and then we find that the WACC is 16.58%. This is the required rate of the return or the cost of the capital for the project. Okay, so there are three kinds of investment: investment A, investment B, and investment C. The investment A has the IRR of 17%, the investment B has the IRR of 13%, and investment C has the IRR of 12%. Okay, so because the required rate of return or the from the investors is 16.58%, then we need to pick the investment that can generate the return higher than the cost of capital itself. Okay, so in this case, because investment B and investment C rate of internal rate of return do not exceed the weighted average cost of capital, this means that these two options are not going to be considered further. And you see that the investment A has the internal rate of return of 17%, which basically means that investment A is able to generate the return as much as 17%, higher than what the investors require. Okay, so that means you should invest in investment A. Okay, that is question number 1. Now we are going to move to question number 2. Okay, you can just read the question here. With the following information regarding capital structure of PT Selamat, calculate the WACC or weighted average cost of capital, assuming a corporate tax rate of 35%. You are given information. So this company uses three sources of finance: debt, common stock, and preferred stock. The company has 9,000 bonds outstanding with a 5% coupon, par value $1,000 with a term of 5 years, sold at 92% of par. Coupon payments are made annually. Okay, so the second one, the common stock. The company has 260,000 stocks outstanding, sold at $57 per share with a beta value of 1.05. And for the preferred stock, the company has 15,000 stocks outstanding with 5% dividend from preferred stock with a market price of $93 per stock and par of $100 per stock. And you're given the information about the market too, that the market risk premium is at 8% and risk-free rate is at 4.5%. Okay, so for the debt, you have the information regarding how much bond is outstanding, the coupon rate. Since the coupon payment are made annually, this coupon rate doesn't need to be divided by 2. Okay, it is annually, and the maturity is 5 years. And since this is an annual payment bond, you don't need to calculate the period too. You don't need to calculate the period either. And then you're given the par value, and the bond price is 92% at par, 92% of the par. So this is the last market price of the bonds. Okay, and as for the common stock, you have information regarding how much common stock is currently outstanding with the price of each stock. And for the preferred stock, this is the information that you can gather from the question. This is the information regarding the market. Okay, so first of all, you need to find the weight for each capital component. Remember that for finding the weight for each capital component, you have to use the market value of each source of fund. Okay, so for the debt, okay, how to find the market value of the debt? You need to calculate you need to multiply this bond price 92% of the par with the par value. Okay, and with the bonds outstanding. Okay, so 92% multiplied by 1,000 multiplied by 9,000. Okay, and you find that the market value of the debt is 8,280,000. And for the common stock, it is relatively easy because you have to just multiply the price of the common stock with the common stock outstanding. Okay, and you find that the common stock market value is for 14,820,000. As for the preferred stock, remember that the preferred stock market value is calculated by multiplying the preferred stock outstanding with the current market price. Okay, so you get 1,395,000. You add all these numbers up and you get that the total market value of the firm's capital is 24,495,000. And how to find the weight? You just need to divide each of this source of the fund with the total market value of the firm's capital. Okay, so for the debt, you need to divide this number with this number, and for the common stock weight, you need to divide this number by this number, and for the preferred stock, you need to divide this number by this number. Okay, so now you have already found the weight for each source of the fund. Next, we're going to find each cost of the source of the fund. The first one, the cost of the debt. We know that the par value is 1,000, the coupon rate is 5% annually. So that basically means that every coupon payment will give you so that basically in every coupon payment the firm has to give $50. Okay, The coupon payment is made annually, time to maturity 5 year, and the price of the bond is currently at $920 because it is 92% of the par value. From this information, you know that the price of the bond currently is lower than the par value, so that indicates the YTM is currently larger than the coupon rate. Okay, you need to find that using the interpolation method. So when the coupon rate equals the market rate, the value of the bond is equals to its par value. Okay, since we are concerned with the YTM, when the value of the bond is 920, um, we need to find the R2 that exceeds the YTM. Okay. Okay, so let's assume that if we put in this 7%, okay, what is the value of the bonds? Remember that the value of the bond consists of two things. The first one is the present value of the coupon, and then the present value of the par value itself. So you need to find the PV-IVA first, or the present value interest factor annuity, and then you multiply the present value interest factor annuity with the amount of the coupon. Okay, and then you add them, and then you add with the present value of the par value, which can be calculated by dividing the par value with 1 plus r. In this case, the r is 7% to the power of 5. Okay, and you find that the value of the bond is, if the YTM is 7%, is 918, which is lower than the one that um, interested we are interested to find. So using the YTM, we find that the YTM, using the interpolation method, we find that the YTM is 6.95% annually. You don't need to multiply it by 2 because it is already stated in annual basis. Okay, this is the cost of the debt. Okay, the YTM is the cost of the debt. And then what about the cost of the common stock? Because in this question we are not given the information regarding the dividend or the constant growth of the dividend itself. And we have information regarding the market risk premium and the risk-free rate that basically indicates that we have to calculate the cost of the equity using the CAPM formula, or the capital asset pricing model. We know that the RF from the information is 4.5%. Okay, you just need to add 4.5% with beta 1.05 multiplied by the risk premium of 8%. Okay, like this. Risk-free rate, we need to add this risk-free rate with the beta, and then multiply the beta with the market risk premium, and we find that the common stock, the cost of equity is 12.90%. Okay, now what about the cost of the preferred stock? For the cost of the preferred stock, we are going to use the dividend and the current price of the stock itself. So you just need to divide this dividend with the market price, 5 divided by 93, and you find that the cost of the preferred stock is 5.4%. After that, we can calculate the WACC, or the weighted average cost of capital. Okay, for this case, we need to plug in the number. E per V, as we have already calculated here, is this one. Okay, 60.50%. You need to multiply it with the cost of the common stock, or the cost of equity, which is 12.90%, and then plus P per V multiplied by RP. So that basically means you need to multiply this number 5.70% with the cost of the preferred stock, which is stated here 5.4%. Okay, and after that you need to add with the D per V multiplied by RD multiplied by 1 minus tax. The D per V is 33.80%. Okay, multiply it with the YTM. Okay, the YTM here, and then don't forget to multiply it with 1 minus the tax rate. In this case, the tax rate is 35%. Okay, so you find that the WACC, or the weighted average cost of the capital for the company, is 9.64%. Okay, that is for the problem 2. And now we are going to move to the problem 3. PT Mara has an expected EBIT, or earning before interest and tax, of $64,000 in perpetuity. The debt amounted of $25,000, a tax rate of 35%, and an unlevered cost of capital of 15%. Okay, based on proposition 1 of the M&M with tax, what is the company value? And then if PT Mara decides to change capital structure to 50% debt, 50% equity with an interest rate of 8.5%, what is the value of the company? And if PT Mara decides to change the capital structure to 100% debt with an interest rate of 8.5%, what is the value of the company? And based on the answer in point A, B, and C, does the company need to maximize the debt? And are there any shortcomings of the conclusion of proposition 1 M&M theory with tax? Okay, so the first one, what is the company's value if we are using 100% of equity? Okay, so since the EBIT is assumed to be in the perpetuity, we just need to like in the formula of this. Okay, so you just need to multiply the EBIT with 1 minus tax, because it is assumed that you have the tax here, and then you divide that with the RU, or the unlevered cost of the capital. Okay, this is basically the formula of finding the present value of the perpetuity, but instead of the usual number, we calculate with the EBIT multiplied by 1 minus TC, and you find that the value of the unlevered firms is $277,333. Okay, for the question B, if PT Mara decides to change the capital structure to 50% debt and 50% equity. Okay, so in this case we are going to use 50% of the $25,000. Okay, and so the value of the firms with the debt is this from M&M proposition 1 with taxes. So you just need to add the value of the unlevered firms with the TC multiplied by D. In this case, the TC is 35%, and then you use 50% of the debt, so 50% of the $25,000. Okay, 50% of the $25,000, and you find that the value of the levered firms, which in this case used 50% of the debt and 50% equity, will result in the value of $281,708. Okay, and for the question C, if the company decides to change the capital structure to 100% debt with an interest rate of 8.5%, what is the value of the company? Okay, the value of the company is going to be, you just need to add the value of the unlevered firms with the TC multiplied by D. The TC is 35%, and then it is assumed that you are going to use all the debt here, so you just need to multiply it with 100%, multiply it by 25,000, and you find that the value of the delivered firms is 286 uh, 1083, okay, dollars. And so from these answers, we know that the higher the debt used by the company, the value of the firm also increase, right? So does the company need to maximize the debt? According to the M&M Proposition 1, yes, the company needs to maximize the debt because it will increase the value of the company. However, like I've presented before, there are shortcomings of the conclusion of the Proposition 1 M&M theory with tax, because in reality, there is bankruptcy or financial distress cost, uh, and as well as the financial risk and the business risk too. So um, these assumptions are eliminated for the M&M Proposition 1. So in reality, it isn't possible um, to use 100% of the debt, because it is going to also increase your risk in bankruptcy and or financial distress. So there is also the materials from the book in this Excel. You can just read it by yourself. If there is any questions regarding the questions or the materials that um, you would like to know, you can just ask to your tutor. Thank you.